Hey everyone, it's Troy Larkham here from Trade Business Accountants, and today I want to run you through how to actually use the Ultimate Labor Rate tool. Now, this tool was really built to streamline this whole process of figuring out what the minimum labor rates are for yourself if you're a field director, as well as your other field workers, like your tradesmen, laborers, apprentices, so on and so forth. So this tool is really to try and streamline and simplify that approach, because if you've gone through the Price for Profit book, you'll notice that the process is a bit detailed and a bit tedious to go through. And that's needed for the process, but that can get really, really difficult and really impractical as well when things start changing in business, because as your business grows, it evolves, overhead costs change, your productivity could change, you might hire someone, you might remove someone's salary increases. All these things naturally impact what this minimum labor rate actually is. So rather than having to get out the pen, paper, and the trusty calculator, it's better to have a tool like this that you can just make small changes here and there within the cells, and it will update these rates for you, ensuring that the labor rates that you're actually using are up to date and they're actually appropriate to your current business model and ultimately where you're projecting to go over the next 12 months. So what we'll do is we'll dive straight in, and I'm just going to run through a bit of an example that you can, I guess, use and reference when you're using it for yourself and putting in your own numbers. So what I want to do now is just run through the tool and how you're actually supposed to use it. So it's very simple. And as you see, as we go through the motions, it is quite simple. Now, obviously, there's a bit going on here that you're looking at. Don't worry, we'll go through the motions and it will start to make a lot of sense very, very quickly. Now, bit of a disclaimer, this tool was built to kind of account for a team of up to 10 field workers. So if you've got more than 10 field workers, please reach out to us and we can create a bit of a custom version of this tool for you that you can use. However, 99% of the people who've bought this tool are likely going to have a team of less than 10 field workers. So this tool is going to be appropriate for you. Now, as we go through this tool, don't try and look forward and try and understand what's going on. Just take it step by step, which we'll go through now. So what you want to do first is get crystal clear on the field worker information. So here we've got field worker 1, field worker 2, field worker 3, field worker 4, so on and so forth. And then on the left-hand side, we've got field worker name and field worker role. So all you need to do here is go through and list out all your field workers. Now, as the director, if you're still partly on the tools, so you're still going out there delivering work, whether it's by yourself or with your team, then you yourself are a field worker. Even if you are, portionally in the office and maybe some of your cost is being covered by your overheads, there's still a portion of your role that is a field worker and it needs to be accounted for as a field worker. So make sure you put yourself in here. So I'm just going to run through a bit of an example. Let's say we've got John, and John's the director. He's a full-time on the tools director. That means, when the business actually needs him working to produce revenue while he's got another tradesman there, let's assume they do more project work, they all work together. So John is never just, in the office when everyone else is on the tools. If they're all on the tools or they're not on the tools at all. So let's keep it in that idea. So we've got John. Now let's say Mitch, and let's say Mitch is a tradesman. And then let's say we've got Jess, and Jess is a second year apprentice. Awesome. So that's simple. What we want to do now is get crystal clear on the annual cost of each of these field workers. So this is really important in terms of understanding, well, once we know the cost over a 12-month period, well, then we can break that down and look at that over what their cost is per hour, which, as you can imagine, is going to be a key figure in us once we figure out markups, our margins and whatnot, to use as the baseline figure to figure out what these minimum hourly labor rates are. So first things first, what you want to do is figure out the base salary cost. So this isn't, every cost. This is just what is their base salary. Now, some of you might have casual workers or laborers and whatnot, and they're on hourly rates. make some assumptions, get a gauge of, how often do you think they're going to be working, and then multiply that by the hourly rate. And that's going to give you a rough estimate as such for the field worker base salary cost. So for John, let's say that his base salary cost is $80,000. So he's got a salary of $80,000. Now we want to start factoring in the other costs. So we've got superannuation. This has recently gone up to 10%. Workers' compensation, 2.7%. Again, this can vary whatever state you're in. Just make sure you're aware of what that actually is. Then we've got our annual estimated overtime cost, annual estimated allowance cost, and other costs. Now, for the director, I'm going to assume that these are zero, and more specifically, the overtime cost is zero. Now, the reason we do that is, as the director, you look at overtime very differently than an employee would. An employee is making money on an hourly basis. Yes, they've got their salary, but them working overtime, they're looking at that from an hourly basis. That's how they're making their money. Where you as the director, you've got to be coming from a perspective of the business, not of as such an employee role. That means you make your money looking at the job as a whole. So in terms of overtime, you're not paying yourself overtime. If ever you work overtime, we like to call that sweat equity. And what that means is, if you choose to work overtime to increase the productivity of your team on the job to get the job quicker. So, and this is a big one as well. To us, overtime isn't a cost, it's an investment into productivity, but that's a whole other note. But the sweat equity side of things is, you're not paying yourself overtime, because if you get the job done quicker, well, then you get rewarded with bigger profits from that job. So that's an important thing to keep in mind. So in this example, we're going to keep the estimated overtime cost at $0. Now, for Mitch, we're going to assume he's got a base salary of $80,000 as well. Now, it's important to note, this is the before tax salary. This is their base salary. This is what you're actually paying. Here we'll do 10% superannuation, 2.7% workers' comp. Now, here, Mitch is a tradesman, he's an employee, so we are going to start factoring in some costs. Now, we're just going to assume that over the 12 months, we're projecting that there's going to be $5,000 in overtime costs that are going to accrue over that 12-month period. Now, we're also going to assume, through things like travels, tool allowances, whatever it might be, we're just going to put a figure there of $3,000. Now, as you can see here, while Mitch's base salary is $80,000, his total annual cost to your business is actually $98,000. And that's really important that we know that figure, because that means we've got an accurate base point to then break down and figure out what his hourly cost is. Now, we've got the final one, Jess, the second-year apprentice, and we're going to assume that she's got a $40,000 base salary. Now, again, 10% super, 2% work, 7% workers' comp. Now, we're going to assume she does some overtime as well. Her cost is going to be quite a bit less than Mitch, the tradesman. So we're going to go $2,000. And then she's also got some allowances, tool allowances, whatever they might be. Let's go $2,000. So again, similar to Mitch, her base cost might be $40,000, but her actual annual cost to the business is $49,000. Now, when we add all of these up, that comes to a combined total of $237,400. So that's the total cost of your field workers to the business. Now, we come down here. We know their cost now over the 12-month period. What we want to start doing now is getting clear on what their cost is every hour. And to be able to do that, well, then we need to understand how many hours that they're actually available to work. Now, this is really, really important to get right, because a lot of people make these assumptions incorrectly. So a lot of the times people look at it, they go, oh, we're 52 weeks in the year, we're working 5 days a week, 8-hour days, that's going to come out to, 2,080 hours. That's actually not the case at all. You've got to factor in those days, the public holidays, sick days, if they're an apprentice, the TAFE days, because these are days when they're not out there productively producing revenue for your business. So you need to be accounting for it to make sure that you're not, eroding your margins because you've incorrectly considered their cost. Because if you imagine, as we go further on, we're using this hourly cost as the baseline to then mark up from. And from that markup, we'll be covering your overheads, trying to achieve your net profit goal, so on and so forth. But if we've incorrectly assumed their time, then we're going to be underestimating what their hourly cost is, because we think there's going to be more hours that they're going to be covering their costs than there actually is. So for example, if their cost was to actually be $40 per hour, if we underestimate how many hours they're actually available in the year, that cost might reduce to $38, for example. Now, $2 might not seem like much as a reduction and as a baseline point from which we mark up, but you stack, $2 over what it might be 1,500 hours. Well, that's $3,000 now in gross profit that you've lost. It's just been completely eroded. So you can see the importance now of getting this right. So what we want to do here is we are going to estimate a official time of 5 days per week in the field. So yeah, they might work the occasional Saturday and whatnot, but the official work days that they work are 5 days. Now, similarly, we're going to say 8 hours standard workday. Again, yes, they might work some overtime and whatnot, but the standard day is 8 hours. That's what's on their agreement. Might be different for you, but I imagine for the large majority, it is going to be 8 hours. And you don't need to factor in the overtime side of things here, because as you remember, we've already factored in that cost. That's already been included in, so you don't have to worry about that. Now, unpaid days off, we're going to say 0. Paid annual leave days. So there's kind of 2 components here. So what this is really assuming is essentially how much do you go on holiday? Well, how much does your field worker go on holiday outside of public holidays? So for the large majority of you, across some of your Easter break, you might potentially have an Easter break, or 4 weeks at the end of the year. What's that in terms of how many days off that is work-wise? So if let's assume 4 weeks that there's an annual leave, or this director John is on annual leave, that's going to be 20 days. So that's 5 days so we've got the 5 days by 4 weeks. So that's 20 days. Now we've got public holidays. So here we're going to just assume 10 public holidays. Now you're going to have to check what that is in your state, because it does vary, but 10 is a fair estimate for this calculation. Now, paid sick days. While as the director, John, he's driven, he's getting out there, he might never actually have a sick day, but it's better to be more pessimistic about the situation than optimistic, because that way we're putting in a bit of a buffer there, and we're assuming that John is actually going to be available less hours than what he actually will be, which in the long run will work to our benefit. So we're just going to put 5 days there. Now, educational days, let's just say there is 0. Let's do the same for Mitch. 5 days, 8 hour standard work week, 0, 20. It's going to be pretty much the same. We got 5 and then 0 as well. Now, Jess, again, 5 days, 8 hours. She's got the same breaks, the same public holidays, same sick days. Now, this is where it is different, because Jess, as a second-year apprentice, or an apprentice in general, they have to do, 1 day of TAFE a week. That tends to be the case. So we need to factor that in. So what we're going to do here is let's just put 50 days there. So that accounts for each day that she has to go away and do TAFE, whether that's once a week. Some people have that set up, or it's throughout blocks. If you look at it over the year, it's going to be roughly around that 50-day period. So if we look at this, we can see that there's 1,800 hours available for John, 1,800 hours available for Mitch, and 1,400 hours available for Jess. Now, I just want to quickly give the example what I was saying before. Because we've accounted for these costs, we're getting an accurate indication of how many hours available, in this case, Mitch is. Now, if we made that 0, and that 0, you can see that 2,080 hours that I was talking about, but that's just not the case. Mitch just isn't going to be available that much time in the year to work for you. So, and that's going to erode on your profit margin, like I was saying, in the long run, because you're going to be underestimating the hourly costs. So again, important that you really do think about and consider and factor in what their actual days away are, and when they're not actually productive to your business, so we get an accurate indication of how many hours they're available to your business to produce revenue. And that's a really, really important figure to figure out. So here we've got the average available work hours of each field worker annually, coming out to 1,666. Now, because we know their total annual cost, we know how many hours are available annually. Now we can figure out what their true labor cost is every available work hour. So in this case, the director, John, he's got a cost of $50. Mitch has got a cost of $54. And Jess has got a cost of $35. Now, I just want to show this example. If we made the mistake of not factoring in the TAFE side of things, and we forgot about that, which we see a lot, you can see here that's gone from 1,400 hours to 1,800 hours, and we've reduced the cost from $35 an hour to $27 an hour. So as a baseline, we're losing $8 per available hour from our apprentice, or Jess in this case. That's going to erode your margins significantly. So again, make sure you're factoring in the appropriate days off that the field workers aren't actively producing revenue for you. So looking at that, those costs there, this is telling us that the average cost of our field workers every available hour is $47.48. Now, what I want to do, because we understand what these costs are of our field workers and where they sit, now I want to start getting clear on what are the annual figures. So what are our targets? What is our net profit goal? You know, what are the overhead costs of our business? Because now we're starting to get crystal clear on what does our margin need to be per field worker per man hour, but also our markup. So we know what to mark up these costs here at to ensure we're on track to achieve our net profit goal and to cover our projected overhead costs. So in this case, we're going to assume that the net profit goal is $30,000. So that means for John, the director, so he's making an $80,000 salary before tax. So that might come out to, you know, $60,000 after tax, whatever that might be. That's what he gets paid over the 12 months from a wage perspective. Now, assuming if he took all of his net profit from the business into his own bank account, this means that he's getting another $30,000 on top of that $60,000 after tax. So net profit is the profit you make after tax. Now, looking at this, we're now going to assume the tax rate. Now, this can vary and it's going to be personal to you, so make sure you consider this appropriately. And it does depend if you're a proprietary limited company or a sole proprietor. So in this case, we're just going to assume we're a company, and as of the 2022 financial year in Australia, the tax rate for companies has actually gone down to 25% if you have an aggregated turnover, I believe the wording is, of less than 50 million, which is going to be the large majority of you. So from here, we can see that we've got a net profit goal of $30,000, a tax rate of 25%. That gives us an annual operating profit total of $40,000. So your operating profit is essentially your EBIT, your earnings before income tax. It's the profit before you get taxed. Now, there's a whole bunch of other things in terms of where you place non-operating expenses and whatnot. You don't need to worry about that for now for this tool. Keep it simple. And in this case, it's just going to be factoring the tax. So this means to make $30,000 in net profit, we've got to make $40,000 before tax in operating profit. Now, the next thing we want to assume is what our projected annual overhead costs are. So these are the overhead costs that we believe that are going to exist over the next 12-month period. In this case, we've assumed I'm going to assume a $90,000 overhead cost. So these are the definition essentially of the overhead cost is anything that isn't, and I guess it's the simplest way to look at it, it's a cost that isn't directly attributed to delivering the work. So costs that are directly attributed to delivering the work are things like labor, materials, equipment hire, subcontractors, et cetera, any cost required to actually deliver the job. Your overhead costs, in, I guess, an elementary level definition, are the costs that occur in your business even when you don't sell anything. Now, there are variable costs as well that do increase with the volume of work, but for the large majority, if you just look at it from a fixed cost basis, that's essentially what your overhead costs are. So this is going to be things like, you know, rent, electricity, software subscriptions, insurance. You know, marketing costs is more of a variable cost because that can vary, but things like, you know, your payments to a Google Ads company or a digital agency company, those kinds of costs that even if the work was to dry up, you have to still pay those costs. Those costs, they're still hungry. They want to eat, you know, 52 weeks a year, 3 times a day. they're the costs that we need to be considering here. So in this case, again, we've assumed 90,000. Now, what this looks like is this produces now an annual gross profit target of $130,000. Where this figure come from? Gross profit is the culmination of your projected overhead costs and your operating profit. So this is how much gross profit you need to make in order to cover your overhead costs and then achieve this operating profit goal, which then after the tax rate achieves your net profit goal, which is what our focus is on. So again, here we've got a $130,000 annual gross profit target. Moving down now, here we're trying to figure out what is the gross profit that needs to be created by labor. So we've got our annual gross profit target. We know that over the year, we need to be making 130,000 in gross profit to again cover our overheads and achieve our net profit goal. Now, when it comes to producing gross profit, there's really two main areas that you produce gross profit. One is the labor and two is materials through material markups. So in most trade businesses, well, in fact, the large majority, labor is where the much larger portion of gross profit is produced. But we need to figure out how much gross profit is being made by our material costs and any other costs, whether we're marking up subcontractors, our equipment hire, and so on. We need to just get a bit of an estimate of how much gross profit these other costs or other job costs are making for the business, because then that's going to tell us, well, what's the difference between that gross profit made versus our gross profit target. The difference is how much that needs to be made by our labor. So in this case, we're going to assume that there's an annual material cost of $100,000. So that means this business is spending $100,000 at the material suppliers as a cost to deliver the work. Now, once those costs are now charged to the job and charged to the client, let's assume that John, the director, has marked up these materials at 25%. Now, quick disclaimer, this is a very simple way of looking at markup. And if you're more of a service-based business and you've got more of a tiered approach, which you should do, it's going to be a bit harder to gauge this average, but just take a bit of a guesstimate. And in that case, be a bit underestimated. Don't overestimate it. Don't be too optimistic with it, because it's better to underestimate these figures and leave yourself with a bigger buffer rather than overestimate them and have a target that you're aiming towards that's actually under what you need to be actually aiming for. So again, keep it simple, underestimate it a bit, and that's going to ensure that you are getting a better indication of where you need to be sitting. So in this case, this 25% markup, that means that we're making an annual gross profit of $25,000. So that's $100,000, 25% of that, which is the $25,000 gross profit. Now, other job costs, this is your costs like subcontractors, equipment hire, whatever it might be, any other cost that is occurred on the job that you can make gross profit from. Now, here we're not so much doing a markup. We're just going to make an assumption on the total figure of gross profit that's created from this. So in this case, we're going to just make the assumption of $20,000. Now, that's the cost itself of $20,000. Now you can look at your profit and loss statement to get a bit of an indication of what that cost might be. But again, look at it over the 12-month period. How much do you think you're going to have to spend on other job costs? Now, here we want to make a bit of an estimate on what we believe the gross profit will be made from those $20,000 in job costs. We're just going to say $5,000. So again, pretty much a 25% markup. So looking at this, we can see that we've got $25,000 created in gross profit from our materials and $5,000 in gross profit created from our other job costs. So that's a total of $30,000 in gross profit that's being created from things outside of labor. So once we subtract that $30,000 from this $130,000, our gross profit target, that leaves us with $100,000. And that means that our labor has to create $100,000 in gross profit in order to achieve this annual gross profit target. So moving on. The next thing here is just some figures that have been punched out. From up here, we saw that the total available work hours. So when you add all these up, there's 5,000 total available field worker man hours for the business. That means, at its max capacity, again, yes, there's overtime and whatnot, but from a standard hour work day and work week across, whether it's 48 weeks, there's going to be 5,000 hours available for you to produce revenue. Now, when we look at that, if we now come back to here, you'll see this $47, which was the average cost of our field workers available annually. Once we actually figure out, okay, well, we need to cover, we need to create this much gross profit, that pops out a figure of $67. So if you were 100% billable, now if you don't know what that means, don't worry just yet, I'll explain that in a second. But if you're 100% billable, that means you're being charged out to the client, 5 days a week, 8 hours a day, every week of the work week, then you would need to be charging your labor out on average across all these three workers that we've got here at $67.48. That way we're covering the salaries, we're covering our overhead costs, and we're on track to achieve our net profit goal. So what that tells us, and again, don't worry about the maths of this, is that we need a minimum labor gross profit margin for each field worker of 30%. And when you transpose that to markup, that becomes 42%. Now, I don't want to go too deep into this, but if you don't understand that markup and margins aren't different, then look into it. We've got plenty of posts on our social media and the Trade Business Success social media that goes into this in a lot more detail in terms of what that difference actually is. But a bit of a summary is margin is what you're aiming for. That's your target that you're trying to achieve in gross profit. Whereas your markup is simply a tool that you use in your pricing approach to create that 30% margin. But again, I won't go too deep into that. But all this is saying is we need to mark up each of these hourly costs, so $50, $54, $35, each of them by 42% in order to figure out what this minimum labor rate is in order to cover their salaries, cover the overhead costs, and achieve the net profit goal. All right, so the next section we need to look at is the average workday billable percentage. So this is, put simply, if you looked over a day, over a week, over a month, over a year, there's going to be an average percentage that your field workers are actually billable over the 8-hour period. And why it's important to factor this in is for a lot of the trade businesses out there, especially service-based businesses, you are not going to be 100% billable. That's just not going to be the case. Over an 8-hour workday, you might be billable five hours of those 8 hours. If you're doing charge, it might be a bit less. If you're quoting a lot, might be a bit more because you can factor in a lot of that dead time, but that's a whole other discussion. All we need to figure out here is what that average billableness actually is. So I recommend looking at it from a week. So if you look over a 40-hour work week, so that's your 8 hours by your 5 days, 40 hours on average, how billable are each of your field workers over those 40 hours? So for example, if they're billable 30 hours of those 40 hours, well, that means that they've got a billable percentage of 75%. So here we just need to make some estimations. And as a bit of a guide or as a reference point, the average for the construction industry, construction and trade as a whole, is roughly around 60%. So again, you don't want to be too optimistic with this figure. Be quite realistic, in fact, even pessimistic to make sure you've got a bit of that buffer that if you estimate a billable percentage that is a bit, too over optimistic, that you're getting it kind of online with where it needs to be rather than overestimating it, getting too confident with it, thinking you're billable 75% of the time when you're actually billable 65% of the time, which is only going to erode your profit margin. And I want to look at what that actually looks like. So for example, I'm going to assume that our field workers are billable, let's go 70%. So what this is showing is that for us to achieve the net profit goal, cover our overhead costs, and cover the salaries of each individual field worker, John, when he's at a 70% billableness, he's got a minimum hourly labor rate of $101.70. And why we say minimum is that's the bare minimum. We actually recommend going a bit above that. This is just a guide of you can't go any lower than this. Otherwise, you're going to be first and foremost eroding your net profit goal because that's going to be the first to go. Now, for Mitch, this comes out to $110. For Jess, this is $71. Now, what I was saying before, let's assume the 70% is their actual billable time or billable percentage, sorry. if we were a bit, optimistic with it and we said, oh, no, they're billable, let's go 80% of the time. Look how much that impacted John's hourly rate. It's gone from $101 to now $88. So in that one assumption, because he was over optimistic by 10% in billable percentage, he's eroding now almost $12 in gross profit every hour of the job. That's just getting straight eroded from his bank account. So 80%, we got 80% here. That's gone from 110 to 96. 80% here has gone from 71 to 62. So you can see how important it is to make sure that you are being quite realistic with this and not being too over optimistic. Otherwise, you're only going to be hurting yourself and your own gross profit. So again, I'll change this back to 70%. Now, this is going to vary, this percentage, depending on really what service types you do. So if you're a service-based business, like I was saying, you're very likely going to be less than 100%. Now, if you're a more project-based business or you do subcontractor work, a lot of the time you might be working, 10-hour days on average or 9-hour days. So you can achieve that 100% billable percentage. In fact, sometimes you might even go over. If you're regularly working 10-hour days, well, then you're going to be over 100%. So we can see here is if we went, 105%, 105%, 105%, look how much that drops the hourly rate. And this is happening in a short summary. This is happening because when we've got a greater amount of hours in the 8-hour workday that we're actually getting billed to a client or a job, it means that there's more hours to cover the cost of the salaries and the overheads and the net profit goal across. So you can imagine if you've got $100 that you need to make, and over 2 hours, that means you got to do $50 each hour to make that $100. Now, if you were to go 5 hours, well, now each hour you only need to make $20 to make that $100. Now, it's a very simplistic example, but you get the point. So that's how billableness actually impacts the hourly rate, and it's why it's so important to make sure that you're accurately considering it. But again, we'll come down to 70%. Awesome. So looking at this, again, John has got a minimum labor rate of 101, Mitch has got a minimum labor rate of 110, and Jess has got a minimum labor rate of $71. Now, if you're looking at those figures and you're currently only charging $80 an hour or something like that, and you're going, there is no way I can charge that, I recommend buying the Price for Profit book if you haven't already, and reading through that, and you'll start to understand how you need to actually be looking at these hourly rates to make sure that you can start using them and start actually continuing to win jobs and be comfortable charging that amount and making the money that you need to be making. Because when we look at this calculator, this is just maths. This is making it black and white. This is what you need to do if you want to achieve and make the money that you want to be making. If you want to sit here and go, I can't charge that, I'm going to keep charging $80. Well, you're going to keep going down the path of being unprofitable, busy, and broke. Now, no one should be in business to be busy and broke. You should be in money ultimately to make money, create a better life for you and your family, so on and so forth. So this is why, there's a whole nother side to pricing, and that's pricing mindset, which we address in the book. I don't want to go into that now, but dive your head into the book and go into our perspective and how we look at things so you can start to get more comfortable at charging higher rates. So looking at this now, the weighted average. So by weighted average, we haven't just grabbed the average of these. By weighted average, we mean that, the apprentice is only available 1,400 hours, whereas John and Mitch are available 1,800 hours. We've got to factor in and weight that as a percentage. Don't worry about the maths behind that. All that means is that the average that you need to be charging all your field workers out at is $96. If you wanted to charge them all out at the same rate across the board, it's going to be $96.40 at a minimum. So, and as you can see, this is really simple. As your business evolves, if a salary increases, you just adjust it. If, Jess, in this case, becomes a tradesman, then we can remove the TAFE days. Everything adjusts simply. We want to set new net profit goals. The tax rate might change down the line, especially if a new government comes in. Projected annual overhead costs, they're always changing as you grow and invest in new things. Material costs can change, especially with different services. Your markup might be different. You can see here how tedious this would be if you had to keep doing the maths yourself. Now you've got the tool to be able to just make these changes on the fly and get accurate indications of where you need to be sitting from a minimum labor rate perspective in order to be on track to achieve your net profit goal, cover your overhead costs, and cover the salaries of your field workers. Cool. So to close this out, here's again, we've just got the $96.40 from here. This is the minimum hourly labor rate of the team. Now, here we've got the combined rate. So for a lot of you, if you're a carpenter or whatnot, it might be you and your apprentice or something like that. You can actually use this combined rate together when quoting jobs, because you're always on site together. For a service-based business, not as important, because you're probably just sending one tradesman out or a tradesman apprentice out, whatever it might look like. But again, there's just a figure for your use. Now, the final thing here is a little table that breaks down the impact of billable time. Obviously, we just did this huge breakdown of what billable time is and how it impacts. But I just want to further that point, because this really is the biggest variable that can massively sway your hourly rate in your favor or not your favor. So it's important that you really do register how important this figure is. So to assist with that, I've also created this table here, which breaks down, well, what actually happens if we were to be too optimistic, or if we were to be a bit pessimistic and think that our billable rate is a bit less. So here we've got the 70%, which is plugged from this figure here. Now that comes out to the $96.40. That's telling us that we're making $28.57. So if we go the $96.40 minus the $67.48, that's going to come out at that $28.57. That's how much gross profit we need to be making per hour on our labor to, again, achieve our net profit goal, cover our overhead costs. So that's what we need to be charging there. Now, if we look here, we're 70%, but we've actually come out where this is what we actually are. So we're performing worse than what we expected. So we're still charging this $96 because that's what we've set, that's what we've figured out. But if you've underestimated, well, that means you're actually only making $23 on averaging gross profit per labor. That's a drop of over $5 there. If you went 60%, so you've overestimated by 10% what your actual billable time is. That means you're only making $17. Now, if you had a really terrible estimate and you're 20% over or 20% too optimistic to what you actually are, and you're only billable 50% of the time, that means you're only making $1.44 per labor man hour, which is huge. Now, which is a huge mistake, I mean, in that regard, and why it's so important, again, that you factor in the right billable time, because in that regard, you're going downhill, you're going negative, you're losing money. So it's important that you're factoring in the right billable percentage. Now, if we would go the other way and you're a bit pessimistic, but you actually perform better, if you were actually 80% billable versus the 70% that you've assumed, well, you've gone from $28 in gross profit to $36. If you're 90%, if you actually hold 20% better, that's $42 in gross profit per hour versus $28. Now, as you can see here, and this is a really important to note, and why it's so important that it's better to be pessimistic versus over optimistic, is with this 70%, if you improve by 10%, your gains in gross profit are only a bit less than $8 an hour. Whereas if you were to lose 10% or you've been overestimated by 10%, here you're losing over $11. So the impact of overestimating versus underestimating isn't linear. It's exponential. So it's important that if you do overestimate too much, you're only hurting yourself at a greater rate. Now, if that didn't really make sense, don't worry. Just make sure, all I'm trying to say is just make sure that you make a very good estimate in terms of where you think your actual billable time is throughout the workday, and that throughout the workday, work week, work month, whatever it might be. And that might be worth literally looking over your past month, 2 months, past quarter, and having a real good look at, well, how billable are we? Because that's going to be a massive game change. And then, over time, you might become more billable, have greater workflow, whatever it might be. Then you've got the capacity to change this, and that will adjust your labor rates. So in a nutshell, guys, this is the ultimate labor rate tool. So through this process, we've quickly and easily figured out what our minimum labor rates are of each of our field workers, which is really, really powerful. Now, again, like I said, these are the minimum. if this was me and I saw $101 for John, I might charge $105. For Mitch, 110, that might be 115. For Jess, 71, I might charge 75. What that buffer is totally up to you. It's just what you want it to be as a bit of a healthy buffer that ensures that you are actually on track and making the money that you want to be making. Now, the second part of this tool is the financial target side of things, or the annual target side of things, because at the end of the day, a labor rate, an hourly labor rate, is only really one half of the equation, because again, it's no good charging $110 an hour if you're billable 1 hour in a week. You're not going to be on track. That's why you've got to marry your minimum or your hourly rate, with a financial target that you're looking and reviewing through your profit and loss statement each month, each quarter, each half year, each year, to make sure that you're on track with your targets that you've set. So what we've got here is our pricing model annual target simulator. So this is just plugged over these results from before. So we had a $30,000 net profit goal. We've got an operating profit of $40,000, a overhead cost of $90,000, which was our $130,000 gross profit target. Now, this is telling us that because now it's factoring in what our gross profit margin was on our labor and our materials and other job costs, it's calculated that we've actually got a 26.7% gross profit margin on the pricing model that we've built here. Now, coming down here, you just got to plug in some numbers. Again, throughout this calculator, you've got to plug in the yellow cells. So here we've got official work weeks worked per year, which is 48 weeks. So we've got the 4-week holidays, official days worked per week, 5 days, average job cost, project value, we've got $1,000. Now, if you don't know what this is, don't worry about this one. It's not as important. This is just to give us, or give you, an indication in terms of how many jobs you need to be doing throughout the year to achieve this revenue target based off your prior performance and your prior job values. Now, one thing to keep in mind here as well, going through this tool, you're probably going to be increasing your labor rates, which naturally means your prices are going to be increasing, which means your average project value in the projected 12-month future is likely going to increase a little bit, or quite a bit, depending on what your current labor rate was sitting at. So looking at this is telling us that over the year, we need to make $487,000 per quarter. That's $132,000, monthly $44,000, weekly $10,000, daily $2,000. So every day we need to be making $2,000 in revenue to be on track. Now, important to note here though, revenue is only one part of the equation when it comes to your financial targets. You've got to marry revenue and gross profit target together. They work together. You can't have one or the other. You can't just look at gross profit either. You need to be looking at revenue too. They go hand in hand in ensuring that you actually do stay on track, because on your profit and loss, you're looking at the top line of your sales revenue, and then you're looking down, after your cost of goods sold, what is your gross profit target? Are we on track? Quick note there. In our experience, we see a lot of contractors, P&L, it is structured in a very weird way and not trade specific as such. And because of that, their cost of goods sold actually don't account for labor in there. And that means you're going to get an absolutely bloated gross profit target, because for most contractors that we see, their labor is sitting in overheads. But as you've seen, and as I've explained, your labor isn't an overhead cost. It's not a cost that just exists. Yes, there's salaries, but it's they're field workers, therefore they're a cost to deliver the work, and therefore they sit in cost of goods sold, which means if you've got that labor sitting in overhead costs, the only cost of goods sold that you're factoring in on your profit and loss statement is your material and potentially, subcontractors and whatnot. So in that regard, all you're doing is minimizing your cost of goods sold, which then bloats your gross profit significantly. So make sure either one, get your P&L structured right, which I strongly recommend, or even for, in the immediate future, is make sure you're bringing those wages and salaries, labor costs, and if subcontractors are sitting in overheads as well, bring them up, because that's going to give you an accurate indication of what your true cost of goods sold is, and therefore give you an accurate indication of your gross profit. But that's a whole other discussion. Just making sure that we're on target here is really critical. So over the year, you need to be making $487,000 in revenue, like I was saying, but you need to be making $130,000 in gross profit as well. So here we got $35,000 in gross profit, $11,000, $2,000, $541. So every day you need to be making $541 in gross profit. This is just a really, really simple breakdown. Now, depending on what type of business you are as well, if you're more of a service-based contractor, you can look at this from a weekly and even a daily basis if you want to as well. Now, if you're a larger contractor, maybe you're a roofer and you're a small team of roofers, you know, looking at this more on a monthly and even quarterly basis is far more appropriate because you do those larger projects and, you know, it's not really appropriate to be looking at it from a week-to-week basis. All right, now that we know our revenue target and we know our average job project value, this is just plugging out how many jobs / projects do you need to be doing throughout the year. So we've got 487, 396, 132, 10 a week, two every day. So that's just another simple breakdown. Now, the final figure here, and a really important one, is your break-even point. So this is the point at which you're not losing money, but you're not making money. So essentially, you're making no operating profit. That's what we're saying here. All you're doing is covering your cost to deliver the job, so your labor, materials, and whatnot, as well as your overhead costs. So this is where you're just breaking even. All you're doing is making your salary and nothing more, and the business is making nothing more. So here, our break-even point is $447,000. So all this is simply is your 487 minus the annual gross profit target here, which plugs out 447. Now you break that down quarterly, that's 121, monthly 40,000, weekly 9,000, daily 1,000. So 1,800, sorry. Now the importance of this figure is, for example, if you look at your P&L over a month and you aren't making at least $40,000 in revenue, then you aren't covering your costs and you're going backwards. And that's a really, really important figure to know. If you know you're above that big figure, then you know you're making some net profit or operating profit. If you're below that figure, you're not making money. So that's just another really, really important figure to keep in mind. All right, guys. So that is the ultimate labor rate tool in a bit of a nutshell. Obviously, you know, we went there for a little bit, but it's important that I break that down so you intimately understand how to use this tool so you can continue to use it moving forward and get the most value from it and really streamline that process of figuring out, one, what your minimum labor rates are of your field workers to achieve your net profit goal, cover the overhead costs and cover their salaries, as well as what are the financial targets or the annual targets that you need to marry those hourly rates with, you know, looking at it from every month, every quarter in your P&L to ensure that you're on track. If you're not on track, you need to start asking yourself, what adjustments do we need to make? Is our billable assumption wrong? Is our overhead projections wrong? Have we underestimated the available hours of our field workers? So on and so forth. These are all questions that you can start to ask yourself to optimize your pricing as well as your delivery process and your workload and improving your billableness. And that way you can start to continue to review through your annual targets, like I was saying in your profit and loss statement, to make sure you're on track. And you want to keep doing that process because if you keep balancing those two together, well, that's just clarity on your numbers and you know where you're going moving forward, which is a really huge deal in the business world because numbers are the language of business. So it's really, really important that you understand what your numbers are and how they interrelate with each other. But that's everything for today, guys. I hope you get really a lot of value from this tool, and I know it will be useful for you. So dive into it, get stuck into it, play around. You can't break it. I've locked it down. So just get a much better understanding with your numbers. Awesome. Have a good one.